or somewhere between 8 Hong Kong dollars and $11.25. Carolyn.
Here to talk about this IPO is Jehn, managing partner of Royal Oak Financial in Columbus, Ohio. Matt, thank you so much for joining us pretty late for you, I guess. So there's a lot of uncertainty about this IPO, given that there are so many book runners. What does it tell you about this IPO?
Well, I think it's telling us that it's running a little bit rich, and they've already pulled the price back a bit, and I think they're pricing it at 15 to 17 times earnings, and it was pricing out at about 20 times earnings. So I think they're being conscious of that and trying to, head off any frothiness, which is good, but I think it's still going to be a little expensive.
At what point do you want to buy the company? What price are you looking at to get in?
Well, I think you can get the lower end of the IPO. If it does go out at the higher end, you want to wait a little bit. I think that this purchase of Smith Foods, that the money they're raising to pay off some of that debt, I think that the upfront cost for this deal to go down is expensive. And I believe you can get this a bit cheaper, but over the long haul, it should do quite well because China has a growing demand, and they have to build out the back end of this to make it work. So there's some time here for it to mature.
Matt, does it surprise you somewhat that senior management have awarded themselves $597 million bonus in company shares when they're trying to pay off for the Smithfield deal?
Yeah, right. I thought that was a little interesting, too. Those are some big numbers, and they were rewarding them for their contribution to the Smithfield purchase. So I'd be interested to know what they did to get those kind of stock rewards, but I'm sure they were top players in that. But again, I think that they paid a high price for Smithfields to get into the market, and this IPO, the majority of that money is going to pay back that debt. And a small part of this money is geared towards building the back-end process of what they're ultimately trying to create over there. They have a lot of ice houses to build. They want to develop some more farm acreage over there. So there's a big back-end piece to this that nobody's talking about. On the front end, they paid the premium, and I think it fits for them in the long haul. But to build the back end of this, I think there's a lot of money left that's going to be needed to build this and make it work.
How would you characterize just the basic fundamentals of the company from a demand side point of view? Because if you look at China, pork, it's part of the staple diet, so much so that it's part of the CPI basket, the inflation basket. So that tells me that demand is going to be robust and is going to benefit them in the long term because of the cash flow and revenue.
Right. I mean, they're definitely going to benefit from being able to acquire pork a bit cheaper from the U.S. So buying Smithfields has given them some reduced purchasing, or greater purchasing power, should I say, and to get pork at a cheaper price. But in terms of how it's going to help them in the long run, their demand is definitely increasing. And again, I think it's a great play. When you look at it for China and what they do, they made a great acquisition for the U.S., and I think between that and what they're doing at home and the growth that they're expecting, it's going to be a great fit for them down the road. Now, initially, I think the IPO price is going to come back a bit, and if they have anything like we're having over in the U.S. with some of the porcine flu, if you will. We have a problem with our piglets over here. We've lost quite a few of our pork. So things like that can really knock them off of their growth plan that they have in the future.
So, in a nutshell, Matt, this is a buy, but not quite right, not right now.
I think you can wait this out. I think you let it go to market, see what happens, and I think after a couple weeks to see where this settles out, that would be your entry point.
You were talking about that swine disease in the U.S. before, and I'm reading a couple notes saying that retail prices for pork products may go up by 15%. Wholesale prices for pork may soar by 25%. Does that automatically mean that my ribs or my bacon in the morning is going to get more expensive?
Yes, that's exactly what that means. Your breakfast is going to be a bit more costly. You know, they've identified 93 farms in the state of Michigan here in the United States that have this dehydration of piglets. And it's only affecting the young hogs, but I think there's a 100% death rate of piglets less than 4 weeks old that get this porcine, if you will, this flu. And they dehydrate and they die. So that's obviously going to hurt, our production and the growth of the pig population.
And hopefully, Matt, we won't see another sequel to Babe as well. That could be somewhat demand negative. Anyway, on that note, I will leave it there, sir. Thank you very much indeed. Matt Jehn there from Royal Oak Financial. Now, moving on, Alibaba continues to generate buzz ahead of its much-anticipated IPO. So just what exactly is the e-commerce giant all about? And just how big is it? Josh Lipton breaks it all down for us.
In only 15 years, it has exploded from just an idea to an e-commerce powerhouse.